Lately, I've gotten a lot of questions about the Fed's recent rate cut and what it means for mortgage interest rates. Will home buyers or people looking to refinance see real relief? Hi, I'm Brandie Jones with the Kingdom Realty Team at Keller Williams, Southeast Los Angeles, and today I'm going to break it down in a way that makes sense and help you know what to watch out for. As you may have heard, the Federal Reserve recently cut its benchmark interest rate, formerly called the federal funds rate, by 0.25 percentage points. This is the first rate cut of the year. This move is intended to support economic growth amid concerns about inflation remaining above targets and signs of a weakening market. Now, let's talk about how mortgage rates are determined. Mortgage interest rates, especially for long-term fixed mortgages, don't follow the Fed's benchmark rate directly. I know we think that, but it does not. Instead, they are much more linked to what investors demand for things like treasuries, especially the 10-year U.S. Treasury yield. If the Treasury yield declines, mortgage rates tend to fall. If the yield goes up, mortgage rates often go up too. Other things that matter: expectations for inflation, the health of the housing market, supply and demand for mortgages, including how many people want to refinance or buy, and what the Federal Reserve is doing with its balance sheet, such as mortgage-backed securities. Hopefully that made sense. Now, let's talk about what the rate cut means now for mortgage rates. Because markets often anticipate the Fed's move well in advance, some effects of the rate cut may already be priced in. That means mortgage rates had already begun to move somewhat before the cut, as investors expected this decision. After the Fed announced the cut, mortgage rates have fallen modestly. For example, the average 30-year fixed mortgage rate dropped to about 6.26, which is the lowest since early October of last year. The rate for the 15-year fixed mortgage has also decreased. Now, let's talk about what it doesn't mean or what could delay the impact. The Fed cut does not guarantee a big drop in mortgage rates immediately. Why? Because mortgage lenders look at long-term factors, inflation expectations, bond yields, and what they think the Fed will do in the future. If inflation stays high, bond yields may move up, canceling out some of the Fed's cut's benefits. Also, the Fed's cut affects short-term rates more directly, but many mortgages are long-term fixed, so the benefit is less direct and often slower to arrive. There's also concern about whether the Fed will continue cutting. Many economists see 2 or more cuts possible this year, but that depends on how the inflation and labor data evolve. So now, I know you're wondering what this means for you. If you're considering refinancing, this might be a good moment. Mortgage rates have eased a bit, so you may be able to save some money versus the higher rates from earlier in the year. If you're shopping for a home, it doesn't guarantee rates will drop a lot more, but any reduction helps. Be mindful of how much rate differences matter for your monthly payment. Keep an eye on future Fed meetings, inflation reports, bond market yields, and housing market dynamics. They all influence what mortgage rates go from here. So, in short, the Fed rate cut is a positive sign and has led to some easing in mortgage rates, but it's not a magic bullet. Mortgage rates depend heavily on long-term inflation interest rates, inflation expectations, and lender behavior. If things go right, inflation comes down and markets calm. Then there could be more relief ahead. If not, it might be more of a gradual process. No matter what, I'll be here to report back to you what's going on in the market. I hope this was super helpful. I'm Brandie Jones with the Kingdom Realty Team at Keller Williams, Southeast Los Angeles. Have a blessed day.